Hi, I'm Hamlin Lovell, contributing editor of the Hedge Fund Journal, and today we are in the London offices of CME Group, opposite St Paul's Cathedral. We're very lucky to have with us today the Chief Economist and Managing Director of CME Group, Blu Putnam.
Yes, thank you.
So Blu, what is your outlook for the global economy in terms of growth for the world and its constituent regions?
The growth outlook for the global economy is fairly slow. There are a couple of different problems going on. In the United States, Japan, Europe, the UK, the biggest problem is actually the aging of these economies. As the demographic group, the over 65 group, retires, they don't spend quite as much money as they used to. They don't make as much money as they used to. And so it's a little bit of a slower growth. It doesn't mean they're not a healthy economy. It just means that they're not going to grow as fast as they used to. And then, of course, China's slowing down. We've all known that for several years. It's still going on. They also have an aging problem, but their issues are more serious in regards to how they cope with pollution and how they set up their financial institutions. So they're maturing as an economy, but that means growing a little slower. And then there's the rest of the world. And in fact, there's some optimistic things there. India's doing very well. Looks like Latin America's turned around. But it's still a relatively slow growth world. But it's a growing world.
Based on that growth outlook, what is the earliest date at which you expect the Federal Reserve might increase interest rates again?
Yes, there's a big debate in the United States over the Federal Reserve's policies, where they're going, where they've been, how well they've worked. The Federal Reserve has a target of a 2% core inflation rate, so they take out energy and food and the volatile components, and they have a mandate to encourage full employment. The employment picture is quite good. Unemployment is fairly low, the economy is creating jobs. The inflation picture is a little bit, it's below the 2% target, but it's still between 1 and 2. And so, we're really at target for both of their things, but the Fed is concerned about the rest of the world. They see what's happening in the UK and the EU on Brexit, and they get concerned. They get concerned about the deceleration of growth in China. They're worried about knock-on effects on the lower price of oil around the world. So they're concerned about the international aspects. And for those reasons, the CME Federal Funds Futures Market suggests no probability or very low probability of any rate hike all the way through into late 2017. So nothing in 2016 and nothing in the first half of 2017. It's what the markets are telling us. And I pretty much agree with that, but I think there is some chance we could get a rate rise in 2017, but not in 2016. The possibility of a rate cut, I think, is close to zero, unless the U.S. economy unexpectedly goes into a recession, and then the unemployment rate rises back up and things like that. And we don't see that happening. You can't discount it. Maybe it's got a 10% probability, but it's a very low probability. So right now we have the Federal Reserve being on hold for quite a long time.
Do you think that heightened volatility and dispersion amongst asset classes and within them is here to stay?
The question of volatility in the financial markets, and particularly in the fixed income markets and overflowing into the equity markets, is a very interesting one, because the debate in the markets that's coming to the fore from the point of view of central bank policies is, have all these policies done any good at all? That is, we've had massive quantitative easing in the United States. Now, they finished their quantitative easing, but they still own all the bonds. We have monthly massive asset purchases from the Bank of Japan and from the ECB. We have negative interest rates in the ECB and in the Bank of Japan. So these are all unconventional policies. The world economy started growing again in 2010, so we're 6 years of growth, 7 years of growth, slow growth, and we have really nothing to show for these policies, nothing at all. We're not growing as fast as the central banks would like. They wanted to create inflation. They haven't been able to do that at all. And I think we have to look at these policies and really try to understand whether they've hurt financial markets and whether they're part of the volatility problem that may be occurring. because, when the ECB buys all these bonds, when Bank of Japan buys these bonds, they destroy the liquidity in their cash bond markets. Now, for CME Group, that means that people will come to our U.S. Treasury futures. The U.S. 10-year Treasury has a yield of 1.4%. That makes it the high-yield bond of the major countries. So it's the search for yield, and people go there. So, the U.S. is a beneficiary of these policies, but they haven't worked. And negative interest rates are, in football terms, is an own goal, because you're trying to get banks to lend more, and it hurts their profits because they can't pass the costs on. So it makes things worse. I think a lot of the volatility that we're starting to see, partly it's obviously a reaction to the politics and the political situation in the EU and the UK post-Brexit, but it's also about the failure of these policies, and should central banks continue them when they're not working.
So which hedge fund strategies do you think are well positioned to profit from this sort of market climate?
Yes, there are a number of strategies that come to the fore. But they're all subject to the possibility that they'll work for a while and then not work. So I think in this kind of an environment, those trend-following strategies will have to be very cognizant of whether they're in a trend that has strong momentum, or whether they're more in a trading zone or a range. And for instance, there's some strong trends that have shown up in some markets. Gold, for instance, has rallied quite strongly around the Brexit news. But how far does that go? So you've got to, as a momentum trader, you've got to realize you could switch into a trading zone fairly quickly, or even reverse a little bit. So I think even those strategies require a lot of monitoring. The volatility strategies, again, if you're in a strong momentum, you can use options to manage the risks of if there's a reversal. If you're in a trading zone strategy, you can use options to either manage risk of if you break out of the zone, or if you stay in it, you can take advantage of the time decay in options. So again, I'm back to looking at different kind of option strategies overlaid on whether you're in a momentum zone or whether you're in a trading zone.
So clearly there are lots of volatility arbitrage strategies that are making growing use of the CME's growing suite of option contracts. And of course, all kinds of hedge fund strategies can use them as well.
Yes, options are the fastest growing set of products in the CME Group. Options traders typically, as they're using options to manage their risk, they also use futures, whereas some futures traders don't use options. Almost all options traders have a more complex view of the world that uses futures and options. The other thing that we're seeing around in our markets is a lot of emphasis on how the different products and markets are correlated. I mean, if you take the day of Brexit just as a case study, so on Friday the 24th, as we were all realizing what had happened and the vote to leave, the pound obviously fell, equity markets around the world fell, and there was a flight to quality. U.S. Treasuries rallied and gold rallied. That was on the Friday, June 24th. But in the 10 days that followed, we had very different behavior. The pound stayed weak, but the equities actually recovered. So they split, paths. And then the U.S. Treasuries, as the flight to quality assets, stayed very low yields. So they stopped moving. And gold held on to its rally. Now, what really happened there was after the Brexit vote, we were looking around at all the central banks, and we said, wow, the Bank of England's going to cut rates. The ECB is going to try to do more to prevent any damage to the European economy. So we looked around the world and said, well, if the central banks are going to be more accommodative, then I want to buy the high-yielding government bond, which is, interestingly enough, the U.S. bond. So the U.S. Treasury was the beneficiary, but the correlations on the day of Brexit were totally different than the correlations in the 10 days afterwards. And so that's another thing that traders and risk managers are really looking at, is the dynamics of correlations. Because, they have trades, but the trades add up to portfolios. And the risk in a portfolio depends on the correlation structure. And that's very dynamic.
How about the outlook for energy prices? Oil prices have virtually doubled from the lows seen in mid-February over the past 4 or 5 months. But then they've seen a bit of a pullback over the past 4 or 5 days. What is driving these moves?
Yes, oil is a really interesting market. You know, in 2014, we were at $100 per barrel on oil, and then we went down, and I think we kissed a low of around $27 a barrel in early 2016, and now we're at $50 range. So a lot of bouncing around in that market. The interesting thing about oil, several interesting things. First off, I think the market is trying to find a trading range, and I think perhaps the $50 is the top, because there's still a huge supply of oil out there. You know, in the summer in the United States, people drive a lot for their vacations. They take their cars, they fill them with their dogs, cats, and kids, and they go driving. So it's the summer driving season. And we typically expect gasoline prices or petrol prices to rise in the summer, and that's not happening because there's literally a flood of both oil and then refined product, even with the high demand. And what's happening is that a lot of countries around the world need the money. So even with the lower price of oil, take Venezuela, that economy is in so much trouble. So they're exporting everything they can at discounted prices. So you might see $50, $45 on your screen, but they sell their oil much less than that. And it goes to a U.S. Gulf Coast refinery, and it shows up as cheap gasoline, petrol for our cars. The Middle East countries, you know, they were planning on $80 to $100 oil forever, and they need the money because they don't want to cut back their social programs and their support of their economies, so they're just pumping oil. So the swing producer in the world today, the one that could cut production some, are the U.S. shale producers. But in fact, they use less rigs. So if you're analyzing the oil market and you're counting oil rigs, you've gotten it all wrong because they've cut the rigs, but the rigs they're using today are nothing like the rigs they used to use. We used to have one oil rig and it drove one oil well straight down, and now you have an oil well that might do 10, 15 an oil rig that does horizontal drilling in all different directions. So the rigs are much more efficient. We get a lot more oil out of any one well or one oil rig. And it's just amazing. So the costs of production have gone down. And so I really think that we touched $27, that was a low. We went up and hit the $50, that was a high. I think we're going to find the zone more in the 35, 45 area for where oil trades for a long time. But we're still working that out as a market.